Thank you for joining us today for the webinar, Audit Proof Your Employee Benefit Plan and Best Practices for Compliance and Accuracy. I am Marissa Ahrens, principal here at Yo & Yo. I lead the Employee Benefit Plan Services Group at the firm. Along with me here today are Allie Barnes and Alan Panter. Both partners are involved in auditing employee benefit plans. Our firm currently audits approximately 100 employee benefit plans. A little bit about Yo & Yo before we jump into the webinar. We're a full-service accounting firm with over 250 team members offering auditing, tax, and consulting work. We also have a medical billing, technology, wealth management, and human resources division at the firm. Now, on to the presentation. We should have time to answer some questions at the end of the presentation, so please send any questions you may have through the chat. Also, please note that this information is not intended to be used as a basis for any decision or action that may affect your business, organization, or situation. Consult a qualified professional advisor before making any such decisions. First, how do you prepare for a smooth audit? So, as I mentioned, I'm Marissa Ahrens. I have over 15 years of experience auditing employee benefit plans. I'm a community activist and a mother of two. So let's jump in to make sure you have a smooth audit. An audit can sound intimidating, especially if you've never gone through the process. However, most plan sponsors are not voluntarily performing an audit. Rather, the audit is required. So how do you make it go as smooth as possible? First of all, why is an employee benefit plan audit important? It protects participants and their benefits, prevents the misuse of plan assets, and ensures the plan is operating correctly. As a participant in a company-sponsored retirement plan, I should have the confidence that my plan assets are correct. Money withheld from my pay should be submitted timely to the plan, and when I am eligible, I should be able to take the amount out that I am entitled to in a timely fashion. Who's included in an audit? There are a lot of people included in an employee benefit plan audit. Information will come from a variety of sources. Those included in an audit are generally plan management. This might be the head of your HR, payroll and benefits coordinator, or your head of finance. Plan governance. This is generally the president, CEO, or a C-suite level employee that is charged with overseeing the plan to ensure its compliance. Third-party administrator and/or record keeper. The record keeper would be the entity that holds your plan's investments. Some plans also have a third-party administrator that assists with items such as enrollments, plan distributions, plan loans, etc. Legal counsel at the organization may also be involved in the plan audit. Investment advisors may also be involved in your audit. Ensure you understand the type of investment advisor you have to know your role as your plan administrator. A 321 advisor acts as an investment advisor, where a 338 function as the investment manager for the plan. So the plan sponsor delegates authority to make the change in the investment lineup to a 338 advisor. Finally, your plan auditor is involved with your audit. You know you need an audit. Have an auditor selected. Now what? Schedule a kickoff meeting with your auditors. Communication is key. Discuss the timing of the audit. Agree on due dates for the audit requests and fieldwork. Ensure these dates correspond with any internal or external deadlines. Discuss significant changes at this time so the auditor can appropriately plan for your audit. For example, did you have a change in your service provider? Were there any significant plan amendments? Did you adopt a new plan document? Identify any corrections or errors that have occurred during the year. Generally, these have a way of turning up in an audit, so be upfront with your auditors about any errors that have occurred to make sure the correction was properly handled. Identify any turnover within your organization, particularly with those employees that assisted with the audit in the past. Ask questions at this time, especially if this is your first year audit. Eliminate any anxiety and gain an understanding of how the audit process works and agree on a plan that sets you up for success. Audit requests. Embrace technology. There is a lot of sensitive information requested for the audit, including payroll and employee demographics. Ensure that you're utilizing a secure file sharing platform. Ensure that the right personnel has access to any portals utilized by your auditors. It'll make your life a lot easier if you provide your auditor with online access to your service provider. This allows us to run our own reports, review participant detail, and request information directly with your service provider. The auditor access is generally a read-only type of account, so you shouldn't have to worry about us making a wrong change. Requests. What will be included as part of the audit? The big one is the audit package. This includes your certified plan reports. It maps out the activity that occurred during the plan year. The census and corresponding payroll summaries. A year-end census is generally required as part of the audit. This should include all employees on payroll during the plan year, not just those participating in the plan. Ensure this census reconciles to your payroll records, not only by employee and employer contributions, but also by gross compensation. If there are differences, investigate. Provide this information to your auditors. Follow up on prior year issues. Errors occurred last year will be reviewed to ensure they were properly corrected. Testing item support. Samples are pulled as part of the audit, including participant data, distribution, and loan sample. Ensure you understand what is being requested from the auditor and who is responsible for providing that information. If the information will come from your service provider, ensure you have an understanding if you need to request this or if your auditor is requesting it. For some service provider requests, some of this information can take several business days to produce. Ensure these requests are provided timely to the service provider to make sure the audit is not delayed. Internal control items. Auditors need to gain an understanding of your plan controls. Be prepared to answer questions about the controls within your plan and produce documents to support that control. Finally, the IRS Draft 5500. Generally, your service provider is the one that prepares the IRS Form 5500. Ensure this is being prepared in conjunction with audit fieldwork. We are required as auditors to review this form to ensure it's materially consistent with the audit report. We cannot release our audit report without a complete 5500. Open items. Generally, all items and questions are not resolved during fieldwork, and open items remain. Make sure to respond timely, understand who's responsible for the request, work with your service provider on any documents needed from them. Admit if you made a mistake or missed an item. Open items will not disappear until they are resolved. If we found an error, that's okay. Admit what happened and work with us to determine the proper correction. Make the audit a priority. It's easy to forget about the auditors after fieldwork or when the audit is performed remotely. However, commit the time and efforts to the audit. This will make the audit process better for you and for your auditors. All right, we're at the finish line. Now what? So your audit fieldwork's over and all the questions and items are provided. So us as auditors will provide you drafts of the reports. Ensure you're reviewing the financial statements and reading the footnotes to ensure they're in line with your plan documents. Review any comments or findings your auditors found to make sure you agree and that you understand the proper corrections. Management representation letter. Once the drafts are approved, a representation letter will be provided by the auditors. Ensure this is reviewed and you agree with the assertions you are attesting to. Provide this signed letter timely to your auditor. We cannot release the audit report without this letter. Final reports. After you receive your final reports, ensure the audit report is provided for the 5500 filing. For the most part, auditors are not scary. We're here to help to make sure that your plan is in compliance with the IRS and DOL requirements and meet your fiduciary responsibilities. Consider us as part of your team. Next, Allie Barnes is going to discuss some common audit deficiencies and appropriate audit follow-up.
Thank you, Marissa. So up next, we're going to talk about some of those common audit deficiencies and what it is we can be doing to follow up on those. As Marissa said, my name is Allie Barnes. I'm a managing principal here at Yo and Yo. I've been working on these retirement plan audits for a little over 18 years now. I'm a leader of our assurance technical team, and I also sit on the quality assurance committee. So, I'm all about following the rules as we get into these plan audits. So let's talk about what we're going to cover here in this presentation. We're going to start out looking at what those common audit deficiencies are, the different types of what we call reportable findings, and then talk about how it is that you can work to respond to those findings that we identify in your audit. So before we get into what the actual deficiencies are that we see most commonly, we need to level set things and talk about our responsibilities as a plan sponsor. So here on the slide, you can see I've put three kind of main areas to consider focusing on. The first is understanding that the plan sponsor has a duty to ensure compliance with the rules and regulations to really maintain that qualified tax status. The second item is ensuring that as you are engaging with third parties, that you have a process in place to oversee the work that those third parties are doing. And then lastly, to make sure that you're administering the plan in accordance with the actual plan documents. So when you're thinking about the audit, if you know you're out of compliance with something, kind of like back to what Marissa was saying, just let us know that there's a problem up front. It's a lot easier if we can plan for a potential known issue versus getting our feet wet and starting the audit and then us discovering that there was a problem. So anytime you can share information in that kickoff meeting right from the beginning is really appreciated. So we're going to get into some of these issues, and I've broken them out into the main categories that we see. So we're going to talk about what the issues are, and then some of the potential causes that we see for these issues. So we're going to start with eligibility. And there's three main issues that we tend to see. The first starts out with untimely entry. So this is when we have a participant that ends up being entered into the plan later than they should have. So if someone was eligible to enter a plan January 1st, and for whatever reason they don't make it into the plan until June 1st, there's a potential issue there. The second one relates to improper entry. So sometimes we have those participants who are eligible, but they're not permitted into the plan. It's not necessarily a timing issue strictly. It's that for whatever reason, maybe they weren't contacted by the provider to even get started with the process. And then we have those ineligible participants who actually are allowed into the plan and should not have been. Our third one then relates to different eligibility requirements. So in your plans, you likely have your employee deferrals and employer contributions. And sometimes within each of those categories, there actually are different eligibility requirements. The most common one that I tend to see is when someone has to be employed at the end of the calendar year in order to receive some type of profit sharing or employer match. So why is it that we end up seeing some of these issues? The first one is just not understanding what our plan procedures and requirements are. We harp on the plan document a lot, and we do that on purpose. The plan document is essentially your guide to all things plan related. So you really need to make sure that you've read that plan document and you understand what it's telling you to do. The next area of eligibility issues that we see, sometimes our data just isn't right. That could be date of birth or date of hire, and maybe it's because of a clerical issue or some type of data transition. problem that's happened. So validating data that's input for the plan is super important. And then lastly, we completely understand. Each of you wears so many different hats, and sometimes there aren't enough of you in a department to really get adequate segregation of duties. And so maybe you have one person performing a role, but there isn't a good second person that can review what's happening. And so there's a breakdown in internal controls. Next up, we're going to talk about contribution issues. So I have to say, the number one common error I see with this is not understanding the definition of compensation. Plan documents spell this out for you. And if it's not spelled out enough, that's an issue in and of itself that needs to get addressed. But this is where we either include a piece of earnings that we shouldn't, or we have excluded a piece of earnings that should have been included. So knowing what the definition of compensation is for your plan is crucial, and every plan can be different. So even if you were somewhere and you knew that definition of compensation, if you're now somewhere else, make sure the plan you're with now, you fully understand what that definition is. Number two here relates to calculation errors. Anytime we have a manual performance of a calculation, we are open to error. So if for some reason this is not being done within a software system, please make sure you're really watching those inputs and formulas if you're using spreadsheets. And lastly, we have late contributions. So once you have withheld dollars from your employees' paychecks, you are required to remit those to the plan as soon as administratively feasible. So if you can segregate assets within a day of the payroll date, or even immediately when you post your payroll ACH to your bank, that's the time really you're required to and expected to be remitting those funds to your provider. So we don't want to be holding those dollars and remitting them weeks later. We need to do it as soon as payroll is being run. So what are some of the issues or the causes here of these contribution issues? I hate to sound like a broken record, but we have to go back to that plan document and really understand that definition of compensation. We also need to make sure that if we're setting up new pay codes, or if we are changing to a different payroll provider, that we make sure those payroll codes are appropriately entered and mapped in the system for the calculation of both employee deferral and employer match. The next item here on the list then relates to those employee deferral elections that are made. So if you have a process where your participants are logging into their account and they can electronically make an election, and then that election is sent to whoever puts them into payroll, we really need to make sure internal controls over that piece are adequate. We see a lot of times where someone has gone in, made an election. Let's say I was contributing 5%. Now I want to contribute 6%. Well, for whatever reason, that change never gets entered into payroll. And so I continue having 5% deferred when I really wanted 6%. Along these same lines, we have the issue where a participant may elect to have pre-tax and then they change to Roth or vice versa. And that particular change does not make it into the payroll system. So really important to understand the process between how the employee makes their election and how ultimately that election makes it into the payroll system. All right, moving away here from contributions, we're going to talk about some distribution issues. So this is an area where I actually see fewer errors, but they do exist. So we'll talk about a couple of them. The first one relates to vesting. So if your employees or participants aren't 100% vested when dollars go into the plan, so if you have some type of vesting schedule, maybe after 2 years it's 20%, 3 years 40%, and so on, that means that if they take a distribution before they meet that 100% vesting requirement, that we're going to start with their gross amount in their account, and then we have to back off the unvested portion before we make that distribution to the participant. So anytime that you are reviewing distributions, it's really important to consider the vesting and if that was correctly calculated. Sometimes it's a manual type issue. Sometimes a system is doing it based on the dates that were entered. So just give it a quick double check. It can really save a lot of headache later having to unravel an issue with this. And then the second relates to eligibility issues. So this happens more commonly when things are being manually performed versus being generated by a system. So just make sure that participants are in fact eligible per your plan document rules to take a distribution. So when we look at some of the causes related to these distribution issues, again, I'm going to go back to that plan document. You may find it crucial to have a copy of your plan document and maybe go through and highlight some of the most important sections here so that you can easily refer back to them when you need to. It's a good tip. We do it in our audit files even so that it's really easy to see what are the main points of your plan document. So I put here for you just a few questions to kind of ask yourself. How are years of service calculated? Does someone have to be here and employed every day of the calendar year? Do they have to work 1,000 hours to gain a year of service? Look for things like that and make sure you understand what's required within your plan. If you have break in service rules, you need to consider that. So maybe someone was employed, they left the organization for a few months, and then they came back. There are rules usually that outline what needs to happen in those cases. So make sure you follow up on those. And then understand the type of distributions allowed by your plan. Some plans allow for early retirement distributions, and some plans allow for something called a hardship withdrawal. Some plans don't. So make sure you understand, yes, in fact, if you see a hardship withdrawal come across, you understand the rules related to your plan for those. Another area that there tends to be some confusion on and people don't always realize is if you have something called a partial plan termination, there are separate rules for vesting that happen when you have a partial plan termination. So if you're under that, make sure you work with your provider to understand what that looks like. And then lastly, we have those issues with different records. Again, inputting census information incorrectly, date of birth, date of hire, date of termination. We need to make sure that is accurately input into the system. And also, if we have some type of a transfer to a different provider, we need to make sure data transfers over correctly too. All right, here. We're going to talk about a few just kind of miscellaneous considerations. We're not going to go into as much detail for these, but I do want to point a few of them out and talk about them a little bit more. So when it comes to forfeitures, we need to make sure that we are clearing out our forfeiture accounts at least once annually. So let's say that your plan has a vesting schedule and let's say someone terminates during the year. They weren't 100% vested. They had $5,000 that ends up being forfeited. And now it's sitting here in this forfeiture account. We need to make sure that we use those forfeited funds once during the year. So if it's December 31st, 2023, for example, and you have $5,000 sitting in that account, when we come in and we look at your plan records for 2024, we're going to expect to see that somewhere during 2024, you would have used up that $5,000 balance that was sitting there from 2023. And again, please work with your providers to get those dollars used and used correctly. Depending on what your plan document says, you can offset expenses and contributions. Those tend to be the two most common I see. They can also be allocated back to participants as well. Then we have our participant loans. Again, this is kind of like distributions. We don't see as many issues in this testing, but when we do, it's usually because a loan wasn't handled according to the plan document. One of those plan document kind of issues is maybe your plan document says a participant can only have one loan outstanding during a year or at a time, and maybe they ended up with two for whatever reason, breakdown in controls. So ensure you know how many loans are allowed per participant at any given time. And then we also can see issues when that amortization schedule is input into payroll. Sometimes there's a breakdown there and an incorrect amount is being withheld and remitted back to the plan, or maybe the schedule gets off for some reason. A few reminders here, kind of in the middle section. Make sure to work with your plan providers to complete that annual compliance testing. The more you can do, kind of, I think of when you're in January and you're reconciling all of your payroll anyways, because you're trying to get your W-2s out. If you can work into your process doing your reconciling for the census kind of at the same time, then you may spend less time duplicating work. So you may want to push it off a little and do it a little later, but you might actually save time if you can roll it into that W-2 kind of process as well. For participant documentation, this is just a reminder to make sure that you are maintaining adequate records, especially if you have an unusual kind of situation. If something happens with a particular participant, put a memo in their file so that you have that to refer back to either when we're testing or should you be audited by either the IRS or the DOL. So that there's just a good paper trail and you don't have to try to rack your brain remembering, what on earth happened here. Plans are required to have ERISA insurance coverage, so make sure you understand those rules and have adequate coverage. And then a couple of reminders here at the bottom to ensure that you are adequately monitoring the providers that you're working with. You obviously trust those providers, or you likely would not have engaged with them, but you should monitor what they're doing, understand what they're doing, and have a good comfort level with the service that they're providing to you. And along with that, you should understand the fees that they're charging and make sure that you're doing that fee benchmarking somewhere roughly every 3 to 5 years and documenting that review as well. All right, moving on here. Okay, Marissa touched on this a little bit, and I'm going to harp on it a little bit more because it's so important. I put on here reconcile, 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 and I do really mean it. So when we come into audit, or if you were audited by someone else, your payroll records should match to your census, which should then trace to your plan statements. So we really want to make sure that you have a process, not just us. We, of course, are looking at this. We have to, it's part of the audit process, but you should be doing it first, not us. So when you're working on that census, it should tie back to your payroll. And then you really need to be getting that annual plan statement and making sure, okay, if my payroll says I had $100,000 for the year in employee deferrals, What does my plan statement say? Does it say I also have 100,000 in deferrals, or does it only say I have 75,000? If it says I only have 75,000, maybe I have a problem. Maybe you don't. Maybe that was the last payroll of the year. They were major bonuses, and it was just a really large amount, and it ends up hitting right there first couple days of January. No big deal. But make sure if there are differences that you understand why you see a difference. And it's not because you actually have a problem and may have missed making a contribution. Year end is especially tricky if you're part of a company that has either special payrolls that get run for bonuses, maybe special payrolls if people have vacation or leave time balances and you do extra payouts for those at year end. Anytime there's something that's not a normal type pay, you really can have additional issues. And because some of those special kind of pays happen right at year end, that's why we tend to see issues when we get in and start auditing. So reconcile, reconcile, reconcile. Your auditors will thank you. They'll love you. In fact, if you have really nice reconciled records, you'll be the talk of the audit department. Okay. So we've made it through all those common deficiencies that we see, and now we need to talk about the finding side of things. So we talk about what's called reportable findings. Okay, so I've broken them out here into three different categories for you. We're going to start out with the most severe down to things that are more like good best practices or pointing out smaller issues. So we start out with material weaknesses. Okay, so this is going to be anytime we have a deficiency, or maybe it's a combination of things that went wrong, where there's a reasonable possibility that your plan's financial statements could be materially misstated, and that misstatement would not be prevented, detected, and corrected on a timely basis. Okay, so that's most severe material weakness. Then we step it down a notch to what's called a significant deficiency. So this is going to be something slightly less severe than a material weakness, but it's still something that we feel is important enough that it should be communicated to those charged with governance in writing. And then lastly, we have those management comments. And hopefully you see management comments more frequently than you would see the other two types of findings. We do have a lot of written management comments. The rules around what we have to report to you in writing became stricter a few years ago. So in the past, there were probably more verbal type of comments, things we would just talk about as testing was happening. More of those now are required to be in writing, which is why you tend to see a lot of written management comments during some audits. So now you have a good basis for what those types of findings are. Now, oh golly, you're sitting there and the auditor has written you up, as some of my clients like to say, why'd you write me up? So we need to step back and first think about the finding, read through the finding, and understand, do I actually understand what this finding is telling me? Do I get the context? Do I remember the item they were testing that led to this? And if you don't, that's completely okay. Let's have some really good two-way communication. Reach out and say, hey, I've had a chance. I looked through this governance letter. I'm not sure I fully understand what these issues are. Could we have a chat about that? We'd be happy to do that. We all want to be on the same page with these. So once you feel good about understanding what the issue was, you want to think about, how are we going to fix this? So we need to think about this in two ways. One, what is the current year issue that happened? And do I have transactions that I need to get corrected specifically in this year? So let's say Maybe someone was supposed to be deferring 10%. They were only deferring 1% due to some breakdown in that percentage getting updated in payroll. Okay, well, mistakes happen. So let's figure out how to fix that for that person. That's really looking at the current year issue and fixing the current year problem. And again, your provider should be able to help you figure out, based on the situation, what is the correction method that you need to deploy. Then you want to think about, okay, if Susie May happened to have this issue where she was supposed to have 10%, she only had 1%, how did that happen? Where was the breakdown in the process? And what do we need to do about that to make sure that going forward, our future transactions are less susceptible to having that same issue? Okay, so really it's two-part. Let's fix the current year, and then let's think ahead and be what I call kinder to our future selves. Okay, let's try to prevent some problems from happening so we don't have the headache of having to deal with it and figure out how we can fix that problem. So when you're in kind of this phase, you do want to pull in other people oftentimes to help you out. Again, that kind of starts with your auditors, making sure you really understand what the issue is, and then working with those other providers, your TPAs, your investment advisors potentially, or if you have some other type of plan provider, reach out to them and make sure that you really know what the best course of action is for getting those fixed. So lastly here, we're all human, right? You wear so many different hats. You're pulled 1,000 different directions during a day, and we understand that mistakes do happen. We all make them. It's okay. These mistakes can be fixed. You want to figure out how to fix them timely so that it doesn't cost more. So if you've made a mistake, just own up to it and figure out the best avenue for getting those mistakes fixed. You don't want to be like these two people that I put here. The one, they've learned so much from their mistakes that they're thinking about making a few more. We definitely don't want to do that. And then also here, I never make the same mistake twice. I make it 5 or 6 times just to be sure. Again, we don't want to do that. It's okay that mistakes happen. We understand, but let's work together to make sure that we're really on a better path so that they don't happen in the future. Really appreciate your time here going through these. I know that was a lot of deficiencies to talk about, but we are going to go back to Marissa and talk a little bit about the Form 5500.
Allie, thank you so much for that presentation. I learned from that, as I always do, and I'm sure others of you on the call also learned a few things. So now we're going to go ahead and jump into the Form 5500. First of all, what is Form 5500? This is an annual report of employee benefit plans that gets reported to the DOL and the IRS. This is basically your plan's tax return. The due date of Form 5500 is the last day of the 7th calendar month after the year end of the plan. An extension may be filed to 9.5 months after the year end. So for a December 31st year end, the initial filing deadline would be July 31st. An extension can be filed, which would take you to October 15th. These returns are publicly available. Some general information to look for on the Form 5500. Make sure your plan year is correct and the correct boxes are checked on the return. Look at your plan name, sponsor, EIN number, and other information to ensure that it agrees with your plan document. Review the participant counts to make sure that they seem reasonable. Account balances drive audit requirements. Generally, the audit rules are: if you have an existing retirement plan and the number of participants with an account balance is over 120, you will need an audit. The audit requirement will not be removed until the count falls under 100. If you have a brand new plan, then the count will need to be over 100 to require an audit. This is all based on the beginning of the year account balances. A few common schedules that I wanted to review is Schedule A. Schedule A is when benefits under the plan are provided by an insurance company, insurance service, or other similar organization. Schedule C. This must be completed if the service provider was paid $5,000 or more in direct or indirect compensation. Multiple service providers might be listed on this schedule and might include your plan record keeper, your third-party administrator, your investment advisor, or your plan auditor. Part 3 of this schedule should be completed to report termination of accountant or enrolled actuary. So if you had a change in your auditors this year, you would need to make sure that Part 3 of Schedule C is reported. Schedule D. If your plan has common collective trusts or pooled separate accounts, this schedule would be required. The big schedule I feel like that we pay attention to as auditors is Schedule H. This is required for a plan that covered 100 or more participants as of the beginning of the year. This schedule reports the financial information about your plan. It should reconcile to the audit report. If it doesn't reconcile, is there a reconciling footnote included in your audit report? Some reconciling differences might be something such as an employee or an employer receivable. Compliance questions on this schedule should also be reviewed. Some particular sensitive questions to look at is your fidelity bond. Is your plan covered by a fidelity bond, and is the coverage adequate? Late contributions. Allie previously talked about the timeliness of remitting contributions to the plan. Are there any that were untimely, that were late? These need to be reported on Schedule H. Filing an incomplete or not filing Form 5500 may cause the DOL to send a letter providing a 45-day period in which to submit a complete filing with the audit report attached. Some of our plan sponsors receive this letter, while others have not. Failure to file or filing an incomplete Form 5500 can be costly. You can see the fees on here. The IRS may charge up to $250 per day, up to $150,000. The DOL is even more expensive, charging $2,670 per day with no maximum. So why should you care about the Form 5500? The plan sponsor is the one signing the return, thus making you ultimately responsible for the 5500. Responsibility should include making sure that the 5500 is substantially complete and in line with the audit report. If an audit is required, the audit report needs to be attached to the 5500 filing. Ensure the proper report is provided for filing with the Form 5500. As previously mentioned, this is public information, so you want to make sure that the proper report is attached. A common issue that we find is that the governance letter, which may include the findings that Allie previously mentioned that we had as part of the audit. This is a separate letter from the audit report and does not need to be filed with the Form 5500. However, oftentimes we see that letter attached because that was one of the reports that we gave to you as part of the audit, so it was just the wrong attachment was provided. This is public information, so if I had findings, I don't want anybody seeing those. So make sure that you're attaching the proper financial statements. And finally, just work with your service provider that prepares the 5500 to make sure it's prepared timely during the audit process. All right, so finally, many of us have heard about Secures 2.0. Alan Panter is going to discuss some items taking in effect in 2025.
Thanks, Marissa. My name is Alan Panter. I'm a principal based in our new Troy office. I have been providing audit and consulting services for over 35 years now, including over 20 years of providing services or doing employee benefit plan audits. My portion of the presentation is going to deal with Secure Act 2.0 and talk about some provisions of that act that are going into effect for the current plan year. So for 2025, these are some of the things that you need to be paying attention to in terms of compliance with the Secure Act. So our objectives for this presentation are to understand those Secure Act 2.0 updates. We're going to talk about auto enrollment. We're going to talk about catch-up limits, and we're going to learn also how this affects part-time workers. So just to give you a little bit of background, the Secure Act 2.0. So it's an acronym, setting every community up for retirement enhancement. It was signed into law in late 2022, and the Secure Act 2.0 expands and refines some of the provisions of Secure Act 1.0, which was enacted in 2020. So Secure Act 2.0 has 29 new provisions. Some have already gone into effect. In fact, many of them have already gone into effect. Some are mandatory. The three that we're going to talk about today are mandatory. There are others that are optional, enhancements to your plan, things that are now allowed to benefit participants a little bit more. There were some optional provisions that were out there as well. But again, today we're going to focus on just those provisions that are going into effect this year. And then one thing to understand about all this is that plan amendments are required to be completed by December 31st, 2026. So that really gets into the plan document that Allie talked about earlier, and just make sure that that's up to date for all the changes that are going into effect related to the Secure Act, not just from 2025, but from the beginning of the implementation of the legislation. The first provision that we want to talk about deals with auto enrollment. So auto enrollment is the idea that once participants attain eligibility criteria to participate in the plan, that they are automatically enrolled in the plan. Now, this is something that we recommend would be a best practice for all plans to have an automatic enrollment provision. But according to the Secure Act 2.0, any plans that are established after December 29th, 2022 are required to include an automatic enrollment provision. So the plans that you all work on and the plans that we are auditing are not affected by this. So this is really just something informational for you in terms of new plans going forward, but auto enrollment provisions are definitely something that are out there now and are going to continue into the future. So any new plans are required to have an initial deferral for those automatically enrolled participants of at least 3%, and it can be as high as 10%, just depending on what is required by your plan. And then each year that deferral percentage would increase by 1% until it reaches at least 10%, but no more than 15%. So those are options that are up to you in terms of how you set up your plan. Keep in mind that employees, can adjust or opt out at any time. So these initial deferral percentages and the increases that they go through every year are not mandatory. Employees need to have, or they should have the opportunity to opt out at any time. So, all right, and plan administration considerations. So update your plan documents. So to include your automatic enrollment provision. So one thing that the Secure Act 2.0 requires is that all plan amendments are adopted by December 31st, 2026. So we want to make sure that that document that Allie referred to before is up to date and contains all the relevant provisions that need to be there. So the other thing that you need to be concerned with is communicating these changes to employees and also to provide those opt-out options for them. So you need to make sure that those processes are in place, that they're properly communicated to the employees, and that they understand what's happening. And the last thing is you need to look at your payroll systems, ensure that they can handle that automatic enrollment, make sure that they're set up to handle those annual increases, because Again, as was previously referenced, we do look at those. So you want to make sure that that enrollment is being done, and those changes are made on the payroll side when they're required. So there's not a lag there where somebody should have had a certain deferral percentage and it wasn't updated in the payroll system. So you need to have a process for that. All right, the next provision has to do with catch-up limits. So of course, those of us who have attained a certain age, 50 or over, are allowed to do catch-up provisions, and that's been around for quite a long time. So those catch-up contributions uh, have been available to us, but under the Secure Act 2.0, those catch-up contributions are increased for participants who have attained the ages of 60, 61, 62, and 63. And that counts for the year in which that age is attained. So when you start the year at age 59 and you end the year at age 60, that's the year that the increased catch-up limit applies. So what this entails is a 50% increase in those catch-up contributions. So in 2025, those in the age group that I said, 60, 61, 62, and 63, get 50%, or they have the opportunity to contribute 50% more than they did in the past. So in 2025, that is $11,250 is the limit on those catch-up contributions, which the age group of 50 to 59 is $7,500. So you get to contribute that extra $2,750. So that is also indexed for inflation, so that'll go up as time goes on. And then a related portion of this, and this is kind of looking forward to 2026, is that for those earning over $145,000, those catch-up contributions need to be Roth contributions. So that's definitely something to think about in terms of both plan administration and planning your own retirement, of course. And so an important thing to be aware of for 2026. So plan administration considerations, again, update your plan document. That needs to be done by December 31st, 2026. Communicate changes to eligible participants. So let people know that that they have that opportunity to increase their catch-up contributions, which may be a significant benefit to them. And again, ensure your payroll system is set up to properly handle this, that you don't have different limitations or that you can handle those increased elective deferrals that employees in that age range are making. And then the last provision that I'd like to talk about deals with part-time workers. So this started with the Secure Act, so Secure 1.0. So the Secure Act requires employers to allow long-term part-time workers to participate in the employer's 401k plans. So the Secure Act provision provides that, of course, except in the case of collectively bargained plans. So we're not talking about any of those collectively bargained plans. So employers maintaining a 401k plan must have a dual eligibility requirement under which an employee must complete either 1 year of service, and that is defined as 1,000 hours of work, or 3 consecutive years of service where the employee attains at least 500 hours. So this is really getting into those workers that are employed by your companies or agencies that are not working that full-time schedule, and they need to be allowed to enter the plan. So that was Secure 1.0, where it was the rule was 3 consecutive years of 500 hours. Secure 2.0 changes that to 2 years. So that 3-year rule is now down to 2 years. So other eligibility requirements that could potentially be in play. Uh, the plan may require a certain minimum age, but that can't be any more than 21 years old. And also, these employees, the part-time workers that get included in the plan are excluded for non-discrimination coverage and top-heavy testing. So some of that compliance testing that you get done that we ask for every year, you don't have to include those part-time workers. Um, the other thing is that these years of employment, as I said, it has to be consecutive, but it also starts January 1st of 2023. So you have to look back to determine who has put in the service to become eligible, and then allow them to enter the plan. Um, and the last thing is that in terms of um, well, I guess there's two things. Uh, the employer is not required to match, although they are allowed to match. So those employees are not necessarily entitled to that match unless you want to provide it to them. And then in terms of vesting, this is something that has to be looked back on as well. So, and this gets into your vesting schedule that is defined in your plan document. Employees should be receiving credit for vesting requirements, towards vesting requirements, since January 1st of 2021. So this is, again, something you need to look back and determine where people fall on the vesting schedule when they are admitted to the plan under this provision. So again, plan administration considerations. We need to update the eligibility criteria in the plan documents, communicate those changes, and ensure your systems are ready to track that part-time service accurately. So with that, I'd like to turn it back over to Marissa to conclude our webinar for the day.
Thank you, Alan, for that presentation on Secures 2.0. That's all the time we have today. We're closing in on the hour. Thanks again to everyone for joining the webinar. Please provide any feedback or suggestions on the webinar to our team so we can improve and better service you in the future. Thanks, everybody.